Exxon Mobil reporting in the last hour. Earnings came in at $1.92 a share. That was 4 cents better than the street was expecting. The oil giant saying that it achieved its highest liquids production in over 40 years with 3.2 million barrels a day. Cash flow from operating activities during the quarter, $17.6 billion. And joining us right now to talk about it is Darren Woods. He's Exxon Mobil's chairman and CEO. Darren, the stock right now up by about 2%. I think what's maybe key in this is a lot of the earnings growth, the earnings power came from what you've been doing internally at the company to try and streamline operations and improve operations.
Yeah, thank you, Becky. Good to see you again. You're right. You know, the transformation the organization's been on over the last 8 years is really beginning to manifest itself. It has been for the last several quarters, and as the commodity cycle goes up and down, I think we're going to continue to see the benefits from the work that we've been doing. If you look across each of our businesses in the quarter, by the way, this quarter, third quarter, is one of the best third quarters we've had in the past decade. In the upstream, we see record volumes coming from our advantaged assets like Guyana and the Permian. As you mentioned, we had the record oil production, or at least oil production, the highest we've seen in the last 40 years. If you look at the earnings per barrel that we're getting out of the upstream business, it's doubled since 2019 on a flat price basis. So take the market out of it. We've doubled the earnings power of every barrel we produce in the upstream. Similarly, in energy products, if you look at the profitability of that business, we've doubled that versus 2019 on a constant price basis. Our specialty business, the year-to-date results are a record. Chemical business, we're up $1 billion versus last year. We've cut out over $11 billion of structural cost out of the business. And then in the new businesses that we're forming, the low-carbon solution business, we're seeing real success there. We've got the only world-scale carbon capture and storage system on the planet, and we've got 5 contracts to store CO2, close to 7 million tons per annum. We are continuing to progress the world's largest low-carbon hydrogen facility, and we've got a real first-mover advantage in the lithium business, where we're trying to implement a new technology and establish a new value chain for lithium. And so a lot of hard work over the last many years beginning to manifest itself in some real wins with respect to the business performance.
Meantime, if you're looking at the broader economy and the broader energy picture, we have seen a little bit of an oil glut, I think. Oil prices down 10% over the last 3 months. What are you seeing in the world, both in terms of oil supply and oil demand?
So I think if you look across all the products that we're producing, but in oil in particular, we're seeing record levels of demand for oil, record levels for demand for products coming out of refinery, petroleum products. But we also see a lot of supply in the world right now, and a lot of that supply is coming out of the U.S. and the unconventional developments that we have here in the U.S. And so it's basically a supply-driven price environment right now. Demand looks pretty healthy as you look across the businesses. Similar with our chemical business, we're seeing very strong demand in chemicals, but at the same time, a lot of supply, a lot of capacity has come on to meet that demand. And so, frankly, like these capital-intensive commodity businesses, it's the supply-demand balance that ultimately is going to determine price. Demand looks good right now. Supply's in excess, and so prices are low. But as the world continues to grow, we'll grow out of that supply, and we'll see prices rise when that happens. Well, and we got to remember, in the upstream and the oil business, it's a depleting resource. So every barrel you produce, there's one less barrel in the world tomorrow. And so that depletion curve eventually catches up to the demand side of the equation as well.
So, Darren, there's been a lot of talk. We've got an election next week. And ahead of that, the markets have been trading energy stocks down to some extent, just on the idea that if Trump wins, you're going to be looking at a drill, baby, drill environment, and that is going to mean lots of supply, and that in turn could bring energy prices down. What do you make of that? You've got a lot of cash, more than $26 billion cash on hand. Would you use that to increase production if you could, or are you meeting the production you need right now? We're just trying to figure out what happens, because oil companies, the oil majors, have been pretty disciplined to this point. But you're right, we've seen a lot more production in the Permian and beyond.
Yeah, I think, Becky, that frankly, our industry as a whole, and certainly our company, has been very focused on making sure that every dollar that we spend is productive and that we're getting a good return for that dollar invested. And that's frankly what's driving the investment levels that we're pursuing. And I also think, frankly, that's what's driving the investment levels of the industry as a whole. So it's less about overcoming restrictions, external restrictions in the system, and it's more about making sure that the technologies you're deploying, the approaches, and in your investment and activity level is being done in an effective and efficient manner so you generate returns for your shareholders. And I think that tends to set the level, and certainly we wouldn't see a change based on a political change, but more on an economic environment.
So, Darren, can you help us with this, though, just because you just said the external restrictions, you think, I don't want to put words in your mouth, would not affect things. And the reason I'm sort of keying in on that is we just had Woody Johnson here, and one of the arguments he was making in favor of a former President Trump's economy, if you will, is that if there are tariffs, the thing that's going to balance off or try to make up for it on the other end is a lot more oil at much lower prices to try to offset whatever you believe the inflationary effects would be. So can you comment on that?
Well, when I said restrictions, Andrew, I was just saying today I don't think the level of production in the U.S. is being constrained by external restrictions. I think it's being driven by what I'd call is the internal discipline of the industry and our company in terms of making sure that the money that we're spending generates the returns. And I think as we move forward, whatever policies get in place, put in place from either administration, depending on how the election turns out, that if that has an economic consequence that then leads to price signals in the market and structural shifts, I think you'll see the industry respond to that based on what those signals dictate. So it's not a function of, I don't think there's anybody out there that's developing a business strategy to respond to a political agenda, quite frankly. I think that would be a very difficult task.
I appreciate that. The reason I'm asking is, it sounds to me like if you're saying this is really a story of economics, it's not about the politics of it, that ultimately it may be very hard to actually get oil prices to be meaningfully lower to offset those the inflationary effects of tariffs. And I'm trying to understand if I'm misunderstanding that.
Yeah, I don't, as we're looking at the business, Andrew, we're not setting our capital plans based on an assumption about whether there's tariffs or not tariffs or how that's going to manifest itself and then the role that we would have to lower prices. I said at the end of the day, again, and I think this is true for everyone in industry, we're making those decisions to invest based on the returns that we think we can generate for our shareholders, the value we think we can contribute. I don't think that's frankly going to change. And the advantage of the unconventional business today, the business that's in the U.S., predominantly in the U.S. and growing, is the flexibility that the industry has to ramp spending down and ramp down activity to lower production if the market environment would suggest that is needed. And likewise, if the market environment gets tight and supply is tight and prices rise, I think there's the flexibility in the industry to increase spending to generate returns. And that's ultimately what's going to drive it. And trying to calculate the derivative of a tariff onto oil prices, we have a hard time just calculating what oil prices are going to do based on the fundamentals. That third or fourth order math, I just don't think we're very good at.